Lending decisions are influenced by structure, not just how you manage credit, but how your accounts are arranged. This is layer 2, structural positioning. Behavior tells lenders how you act. Structure tells them what they are evaluating. Structural positioning refers to the composition of your credit profile. How many accounts exist, what types they are, how long they have been open, how they are distributed across time. Two borrowers can demonstrate similar behavior, but if their structures differ, interpretation shifts. Imagine two profiles. Both pay on time. Both manage balances responsibly. One has 3 credit cards and a long-standing auto loan. The other has one recently opened card and nothing else. Both may look responsible, but one profile has depth. The other has limited data. Lenders price risk based on available information. More mature structure creates more measurable history. Thin structure limits predictability. This is not about having more accounts. It is about having sufficient structure. Structural positioning answers a simple question. How established is this credit profile? Length matters. Distribution matters. Diversity matters. For example, a profile where most accounts were opened within the last year looks different than one built gradually over several years, even if both currently show on-time payments. Time inside structure increases confidence. Another structural factor is account mix. Revolving accounts demonstrate flexibility and short-term management. Installment accounts demonstrate long-term repayment ability. Neither is superior alone, but together they provide balance. A profile with only revolving credit may feel more volatile. A profile with only installment debt may feel less flexible. Structure shapes context. It determines how behavior is weighted. Strong behavior inside a thin file has limited history to support it. Moderate behavior inside a mature file may still feel stable. This is why approval is not based on a score alone, because the score compresses structure into a number. Underwriting expands it back out. They look at account age distribution, average account age, time since newest account, time since oldest account, account concentration. Structural positioning is about foundation. A house built yesterday can look beautiful, but lenders trust structures that have weathered time. The same applies to credit profiles. This does not mean you need dozens of accounts. It means stability must be demonstrated within the structure that exists. Sudden structural changes can also influence interpretation. Opening multiple accounts in a short window changes structure quickly. Closing long-standing accounts can shorten history. Both actions will alter positioning, even if behavior remains responsible. Structure moves more slowly than behavior, which is why it carries weight. It cannot be corrected overnight. It matures gradually. Layer 1 showed how habits shape interpretation. Layer 2 shows how the profile itself shapes confidence. Behavior without structure lacks depth. Structure without stable behavior lacks trust. Both are necessary. but they are not sufficient alone, because even strong structure can be reinterpreted if timing becomes unstable. That brings us to the next layer: timing. Not just what your profile looks like, but when changes happen and how that sequence influences approval.